Hello and welcome to our special programming on US tariff wars. What does this mean? Because stock markets across the world are falling on the back of Trump's tariffs and increased fears that the world's largest economy, the US, could go into recession. In fact, some experts say invest in the markets now since the valuations are cheap. Others say sit tight on the sidelines and wait for this to play out. Yet others say that you should move your money out of equities. Now, in this confusing situation, it is natural for investors in India to be worried about what they need to do to safeguard their money. Uncertainty is perhaps the most difficult scenario to tackle, and because no one really knows what's going to happen, there are estimates and guesstimates galore. At NDTV Profit, we're asking the questions that many of you have and provide you with sound, recent advice from the best of the experts. For many of you, this is probably the first market fall you're witnessing. Panic will not help you in any way, so we urge you to keep calm and weather the storm and keep watching NDTV Profit to get the best advice on how to be resilient in these trying times. In fact, we will get you market voices who tell you what to buy, what to hold tight, and what you should be doing. First up, we have the focus that's coming in terms of domestic consumption theme for the next 2 quarters. And this is what market expert Nischal Maheshwari said on the current market situation. He added that there's no point in selling in the kind of market that we are in. Let's listen into a bite of that conversation.
Yes, it's been a turbulent morning, basically. Yes. At the moment, I think the best thing to do is just stay away from the market. There is no point on catching a falling knife because you really don't know how the other countries are going to react. China has already done it. Most countries, smaller ones, basically have all come to the table to negotiate. So let's see how all this pans out. I think it's best to avoid for next one and a half week, see how all these things pan out. Maybe the Nifty will go to whatever levels. Nobody can predict that. So best to avoid. There is no hurry to buy in this market.
To buy, but then would you avoid selling as well, Nischal? Because the point is that, and here I'm talking about something like a trend. Okay, so there was a business update that perhaps was not as rosy as some would have liked, but 28% growth in the revenue for the fourth quarter was expected of over 35%. It's a stock that is down 17%. It's a Nifty 50 stock. Do you avoid selling as well is a question.
So it depends upon basically whether it's been selling because there has been some margin calls. If there is no margin call, I don't think so at this point, basically not only trend, but anything. There is no point in selling in this kind of a market. The markets are very low. I think some sane sense is going to come back to this market and maybe you will get better rates basically to sell. So I totally agree with you basically that there is no point on actually going out and panicking and selling at these levels. Yes, you may still see lower levels than this. That's what I'm saying. I'm not sure basically how low it can go, but there is no need to panic at the moment because I'm saying, yes, conditions are bad. And but what my thought remains to be that cooler heads will come to the table and things are going to work out, not at pre-tariff levels, but definitely somewhere in between the pre-tariff and the level of tariffs which the Trump administration has put. So across the world, I see maybe there is going to be some giveaway, mostly a 10%, which was the base level of tariff, and some percentage above that. But then it is much better than what we are today. So that's why I'm saying basically just cool off and see for the next 2 weeks how this market comes, and then only whether you want to buy or sell, then only take a call.
Okay, and Mr. Maheshwari, if you wait for 2 weeks and we see a significant dip in the next 2 weeks as well, any counters that you would want to enter into and see that these counters are now looking attractive where valuations are concerned? And will those bets be domestic play bets?
Surely, I think last week itself, basically, I think it has become clear that you have to focus on the domestic companies for the at least next 2 quarters. And beyond the next 2 quarters also, I believe the Indian economy is going to revive. I think the government is taking enough measures, whether it is the rate cuts. I expect another rate cut to happen in another couple of days. Then there has been an income tax cut. So I think all those things, measures which the government is doing, basically will show up in the second half of the current financial year. So that's why you are saying basically that at least for the next 2 quarters, wait out, and thereafter basically we are going to see earnings coming back. Maybe some amount of earning upgrades also happen in the second half. So better economic sense will prevail.
Nischal, if we're talking about, and your point is well made, right? Because if you're talking about announcements that the Chinese government is already making to focus on domestic growth, you'll have European leaders that are talking about, hey, don't invest in the US, questioning whether or not it makes sense and saying double down on investments in Europe. So if all of these geographies, and I take your point to say that perhaps a common ground will be found on trade, but once bitten, twice shy. If you're dealing with the US administration, you'll have a lot of administrations around the world that will double down on domestic growth. And so from that perspective, for the Indian investor, what areas do you see? For example, financials have been relatively resilient. And in order for domestic to grow, you need financials. Similarly, you would talk about cap goods, you would talk about power. What are the places that you would look at and say there is value here?
So I think financials definitely as a sector basically has got good value, and it's not performed for the last 3-4 years. So I think the outlook seems to be good for the financials. If we have another rate cut happening, which is most likely to happen, I think it is going to be favorable for the whole financial sector. So financials is one. I would for the moment still wait out to see whether the consumption is coming back or not. Because there, I think with these kind of numbers, there are question marks. FMCG, it's a very mixed bag. There are a couple of companies saying yes, others are saying no. So really, I think one should wait out for the consumption sector. Government spending is another definite thing happening. Government spent around 12 lakh crores last year. I think similar number is happening this year also. So I think there you should be looking at industries like cement. Steel is a global commodity, so avoid it for the moment because you don't know if there is a tariff war between China and US, so China has to find newer markets to dump their steel. So India could be one of them. So avoid steel or metals for the moment, but cement is one basically definitely you should look at. The other ones basically capital goods to an extent. But capital good one has to be very clear saying that it's not the companies which are exporting because India has a large capital good export to the US also. So one should be very careful where we are investing.
In fact, Kotak AMC's Nilesh Shah also echoed Nischal Maheshwari's opinion and said that domestic-focused companies will stand out in this storm. Let's listen into that conversation.
Today, we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. It cannot afford current account deficit at 3.5% of GDP year after year, despite having reserve currency. The debt to GDP ratio at 125% with unfunded pension liability, clearly they needed to tackle. The objectives are right. The process has been fairly difficult to understand, and which is why this uncertainty is likely to persist. The process which they are following, it will create lose-lose situation for US as well as the globe, and hence there is little hope that it might get reversed before it is too late. In the order itself, there is a clause 4 which says that America is open to negotiation. Vietnam, which allowed China to use their base for manufacturing or actually assembling and exporting to US, has already announced that will make zero tariff. So there will be negotiation, and that's the hope. But clearly, that uncertainty is likely to persist as President Trump remains fairly unpredictable.
Nilesh bhai, so can it happen that because of this uncertainty prevailing, and who knows, it could last for a better part of 2025, can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right?
Undoubtedly,
Can it happen?
Neeraj bhai, markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Got it. Nilesh bhai, just pure domestic plays. So I mean, you maybe put in cement out there, and I wonder if steel, for example, while it's a global play, but because of the duties having been added, that does it kind of qualify as a quasi-domestic play now versus it being a global play? I'm just trying to think, what do you think of pure domestic assets like cement, steel, and some of those commodities? Not steel,
So
but cement for sure.
undoubtedly is pure domestic sector. You can't export much of a cement, you can't import much of a cement because of bulk nature. On the steel side, undoubtedly, there is little bit of exports, little bit of imports as well, and largely it's a domestic-driven sector. But the most important thing for us is that steel or any other commodity is a sector where tail wakes the dog. There will be excess capacity in China. Their free access to US is getting curtailed. Their free access via using countries like Vietnam to export is also getting curtailed. And that extra capacity could be used to dump in rest of the world. We are one of the largest market and also nearest to China. We'll have to be very, very proactive in levying tariffs on Chinese imports. Otherwise, it can hit a sector like steel. So in steel sector, apart from domestic growth, domestic demand, we'll have to also see how proactive our government is in levying tariff on Chinese imports.
Meanwhile, Robert Sockin, senior global economist at Citi Research, talks about the approach of countries amidst global tariff outbreak. He also emphasizes on how is the US economy going to pan out from here on. Let's quickly listen in.
Right now, we're assessing many channels through which the tariffs will impact the US economy and the global economy and economies that are directly hit with these tariffs. And there's kind of the math of the direct effect of what these tariffs will do. But then there's all sorts of channels through which those effects could be worsened and magnified. In particular, if consumers and businesses really get concerned about this environment and they start to pull back spending even more, investment even more than they would otherwise with these tariffs, you can get kind of magnified negative effects. And I think with the way this first couple months have moved, with a lot of uncertainty and a lot of surprises from the Trump administration, I do think uncertainty is here to stay. Even if you end up with some negotiations on these tariffs, you could get more tariffs coming on and off. It's a very hard environment to plan. And so I think at least for the foreseeable future, uncertainty is going to be high. And that really runs the risk of weighing on economic activity and also weighing on financial markets.
In fact, we also caught up with Nomura's Sonal Varma, Managing Director and Chief Economist, India and Asia ex-Japan. Here's what she had to say about the tariff war that is likely to play out.
So I think the direct impact is probably easier to estimate, given India exports about 2.2% of its GDP to the US. So we know that there's probably a 20 to 30 basis point kind of a direct impact. But I think this is much bigger than that, and that is where the concern really is. It's really the weaker global demand, uncertainty weighing on investments. Tighter financial conditions, which basically feed back into weaker business investment, and also hurting consumer demand because of the negative wealth effect. And actually, the second round effects are extremely difficult to quantify and are still playing out as we speak. So our growth projection for FY26 is at the low end of consensus. We think growth will be softer the ongoing financial year at 6% on a year-over-year basis. But we do see downside risk even to this projection. And globally, Neeraj, we've cut our numbers more significantly for other open economies in Asia, and for the US as well. We've downgraded our growth numbers for 2025.
That was going to be my next question, that would you reckon that global growth at large, as it stands, takes a significant cut on current scenario? And does that, Sonal, change meaningfully? Let's say growth for the ASEAN region, does it change meaningfully if economies are able to strike some kind of a deal with Donald Trump? Because everybody from, at least in Asia and Australasia maybe, Australia, Japan, Vietnam, all of them are on record saying that they want to go to the US, talk to Donald Trump and try and reach a deal.
That's right. I think outside of China and EU, at least most of Asian countries are looking to negotiate with the US rather than retaliate. And this negotiation is either in the form of lower tariffs, more investment in the US, buying more of US goods. So a lot of countries are offering that. The question is, the reciprocal tariff is actually not just about lowering tariffs. And for instance, the VAT or the GST that countries charge this is an important source of fiscal revenue for these countries. And therefore, it'll be very difficult to negotiate on the GST rate, for instance. Similarly, the tariff on politically sensitive sectors like agriculture is potentially non-negotiable in a number of countries. So I think it is possible that some countries do manage to negotiate their tariffs slightly lower going forward. But even countries that actually have basically an FTA with the US have been slapped with a 10% tariff. So the extent of rollback on tariff is possible, but may not be very substantial. And therefore, our assumption for the US is that US effective tariff rate on its import will be above 20% this year. And if the US wants companies to invest in the US, then they will likely keep tariffs high for some time. So the tariff rates will also be sticky. So some rollback is possible, but I think, it may not be very substantial is what I'm saying. Now, what it means in terms of global growth, nevertheless, is that the tariff shock is quite significant, both directly as well as indirectly through the various channels that we discussed. Particularly for the US, it is a stagflationary shock, and we have cut our growth projections for 2025 for the US. So on a Q4 over Q4 basis, we've cut our numbers to 0.5% down from about 1.4%, so nearly a percentage points drop. For rest of the world, it's more of a negative growth shock as well. So for Europe, Euro area and Japan, we've cut our numbers by 0.2 percentage points. And Asia, we think, will be hit the hardest because this is basically home to the open economies in the region, and the tariff rates on Southeast Asia are quite elevated at between 35 to 50%. So the growth impact will be quite substantial for countries like Vietnam, Thailand, Singapore, Korea, Taiwan. So we've made cuts anywhere between 0.3 to 0.6 percentage points across countries.
Moving on, the other commodity which is impacted right now is crude. Actually, it hit a low of almost $60 per barrel. We also spoke with Vandana Hari, expert in the oil and gas space, about how deep the crude fall could be from here on. And she believes that the levels absolutely depend on what US President decides to do. He is the only one who can put a lid on the pricing right now. Let's listen in.
That's probably, those are the most important questions and probably the hardest to answer. With regards to how much lower we could see prices go, I think it depends on what we see in the coming hours. And I'm saying hours rather than days, because I am expecting Trump to put out some kind of messaging, some signal that things are not going to be as bad as the markets are fearing, that what he's doing, he's talked about short-term pain, right? But I'm not sure that pain, that recession qualifies as the pain in his statement. So watch out for what Trump does and says. If he signals that it's not going to be as bad, I would expect crude first to find a bottom and second to start moving up. Your question also was, how quickly it will move up? I think it will be very, very cautious, because it will take time for the markets, for the dust to settle. This is a huge shock. There's going to be aftershocks and ripple effects. So the market will be cautious. But at the very least, I think Trump is the only person who can put a floor under prices right now. And as we've seen last week, OPEC Plus has left the stage. So there's really nothing else that can come in to rescue. And I don't think the Fed either. I noticed you were talking about that earlier. I think they are in a wait and watch mode as well.
So what is the upside at this point? Is it too early to call?
Yes, I mean, look, you start thinking of all the supportive factors, one of them being, for instance, that, you just mentioned that TI slipped below 60. Even in the low 60s WTI, it is a bad environment for the U.S. shale sector. So you can assume that instead of the 200 to 300,000 barrels per day increment in U.S. oil output that we were factoring in for this year, at low 60s, below 65 WTI, it's going to be closer to zero. The other argument typically that comes into play is that as prices fall, that will ease inflationary pressures. There will be a little bit of a fillip in demand as a result to low prices. But see, the thing to keep in mind is all of these are very slow-acting factors. So as of now, again, they are not ones that can quickly step in or will quickly step in to steady market sentiment. So we, as I said again, I'll repeat that I think it's watch out for what Trump says and does in the coming hours.
So inventory losses with regards to OMCs, and if you talk about marketing margins, that could improve. So it's a double whammy with regards to, which direction OMCs go from here on, but an interesting aspect that we should be considering as well. But moving on, we also spoke to Wockhardt founder Habil Khorakiwala, who said that Indian pharma companies that export to the US could face some pricing pressure as well as a temporary drop in sales. This was in connection with what impact the tariffs could have on the sector. Let's listen in.
Currently, there are no duties on pharma, but what will happen in future only Trump will know. I could mention that the impact, it's not easier for anyone to switch manufacturing from India or anywhere else to US. So in the short term, certainly there would be a price pressure on US consumer and healthcare provider in the US. As far as Wockhardt is concerned, we hardly have a significant presence, hardly less than 5%. and we have planned to exit the US generic business. But many other pharma companies have a very large exposure to US business, somewhere between 30 to 50% of their revenue. And they will have to adjust themselves by maybe a little squeeze in margin, little impact also on the sales, because it may affect, but it will be very, very difficult for pharma industry to manufacture all the products in the US, because it will take several years to do that. And it is a multi-product industry, because we have so many products, so many API suppliers, and many of them are from India and China. US hardly manufacture much of the active substance. So it's going to be a fairly complicated affair, but the end result would be the US consumer and healthcare provider will have to accept a significant part of a burden. And the future of pharma industry from India, who have a very large exposure, they would certainly rethink their future strategy. And probably they would diversify the business a little more away from the US.
So that's the overall roundup of what is happening in the markets currently. Completely out of time. With that, it's a wrap on this edition of at NDTV Profit. Please stay tuned to lots more.